India tonight. With a growth target of 5.5%, clearly the Chinese government is making an all-out effort to keep its growth on track. In the very latest, the Ministry of Finance in China says it will consider allowing local governments to sell 1.5 trillion yuan, which actually amounts to $220 billion worth of special bonds, and this in the second half of this year. This kind of acceleration for infrastructure funding has really never happened before in China. But of course, in these current environments, it may be turning inevitable just to shore up China's beleaguered economy. The debt, of course, once China does this, is going to rise. It's mostly, of course, going to be used to pay for infrastructure spending. It's an old trick that has been used to boost the economy, an economy that has been hit by COVID lockdowns, also a huge housing slump. In fact, among the other measures that have been taken, the world's largest car maker also wants more people to buy cars. It has extended tax breaks for electric vehicles, and the Chinese have also outlined plans to build more charging stations to encourage lower charging fees as well. Earlier, in fact, they had halved auto purchase tax to 5% for cars that are priced under 300,000 yuan, the cars with small engines. So all these measures in toto, they are aimed to help President Xi Jinping's government get the economy back on track. But how much will it help? And how much does this reflect the fears of a global recession that are before us? On the show, to discuss this, we have with us David Madden. He's a market analyst with Equiti Capital. Also, José Torres, the senior economist at Interactive Brokers, is joining us on the show. Great to have you both with us, gentlemen. Let me come to you first, José. As far as my memory serves me, back in late 2008, China had been the first to announce a very large and perhaps the largest stimulus package in the world. And back then, the world was battling the impact of the global financial crisis. China was also the first major economy in the world to emerge from that crisis. Growth was 8.7% in 2009, and the following year, it was almost 10.5%, which is a remarkable recovery. I want to ask you, José, how different do you think the story is this time after the impact of the pandemic that we've seen at a time when the world is grappling with slowdown, with the possibility of a recession? Can China emerge stronger with this kind of stimulus, you think? $220 billion is what they intend to pump in, and largely into infrastructure.
Good evening, Vikram, and thanks for having me. They've relied on debt too much over the years. I don't think that relying on more stimulus and more debt is going to help them emerge stronger this time around. COVID lockdowns, a housing downturn, and a global economic slowdown have negatively affected the Chinese economy. They're desperately looking for ways to achieve their 5.5% target against the backdrop of weakening conditions. Low inflation and high unemployment make it possible for China to be easing currently while the rest of the world is tightening. So I don't think that this stimulus and this these debt levels are going to help them emerge stronger in the coming years.
David, do weigh in on this because the markets globally have reacted quite favorably to the possibility of this kind of stimulus package in China. Do you think that interest will sustain? Because many would say that fears of a recession, in fact, is getting spurred by that itself, the fear. And if that is going to cause recession, then as far as sentiment boosters go, this is a large enough stimulus package that could help the market sentiment stay up.
Well, I think it's more of a delay from the defaults that we're seeing in the real estate sector. And I think the Chinese know that if they don't add stimulus now, there could be some significant problems in the near term. And we've already seen a lot of defaults and a lot of slowing economic activity overall. So I don't think that, I think this is a near-term solution. I don't think this is a medium-term, longer-term solution.
Even so, now China in the past, if we've seen, they've also spurred bank lending, and they've used that to fight slowdowns. It has spurred demand for commodities, for consumer goods, and on the face of it, it seems tried and tested because the Chinese have reaped rewards from it in the past. So do you think it would help the Chinese economy and in turn the global economy with what they intended to do right now? David, what's your sense?
I would have to agree with excuse me. I'd have to agree with Jose that it's very much more of a short-term fix rather than a medium to long-term solution. Excuse me. The financial markets, have certainly welcomed the news, as they often do regarding stimulus news. But it's one of those things, you can only get a cry wolf so many occasions. As Jose pointed out, China is just kind of adding to its debt, adding to its debt, adding to its debt. You can only play that hand so many times to turn around your economy. Of course, the stock markets have been boosted by the news, in partially because of the news out of China. But if you look at how kind of stimulus packages run, be it in the kind of 2008 banking crisis or the Eurozone debt crisis or post-pandemic, after a while, the impact, the feel-good factor starts to diminish. If anything, it becomes a case of diminishing margin returns. So I think this isn't going to be the kind of the silver bullet which kind of finally shakes off any uncertainty investors have about China. It'll be something that will lift the markets in the short term, but we'd want to see China actually turn around in terms of services, manufacturing, retail sales, and the likes, particularly post the pretty severe lockdown in certain regions of China recently, before traders can get a more of a sustained belief this is actually properly going to play out, not just something that will grab a headline and not just something that will temporarily lift sentiment.
You're absolutely right about that, David. China's zero COVID policy has had a very significant impact on its economy. And some cities, they've had strict lockdowns for nearly a month. Even parts of a commercial hub like Shanghai had closed down for more than a month, all of which disrupting their logistics network. Their entire supply chain was disrupted. In fact, many would say that China has really no alternative but to have this kind of stimulus right now to fight the impact of those strict lockdowns. Jose, would you agree with that?
Yes, I would agree. And I'd also add that demographics are stretched. The working age population is declining. Finding additional growth verticals will be difficult in the coming years for China. And I think that also adds to the argument of them not being able to emerge that much stronger versus 2008.
And now, of course, when you talk about the areas in which that China would like to concentrate, there is the infrastructure universe. Real estate investment has always been an important indicator of economic health because, yes, in China, the property sector plays this outsized role within that economy. This kind of sizable amount of the stimulus perhaps will be allocated towards real estate, but they are also talking about a big spurt for electric mobility as well. How is this likely to play out, in your opinion, at this point in time when we are looking at the slowdown? And as far as industries are concerned, commodities, the input costs are going up all across the world. How is this likely to impact the commodities markets and exports from other emerging markets like India when they are concentrating on perhaps infrastructure and electric mobility? David?
I think it's a shrewd move to have some sort of diversification thrown into the mix, but also let's not forget this also will rely on personal debt. If people are going to be going out spending their hard-earned money on electric vehicles and other sorts of items. So it's all well and good saying we're going to spend more money in a different aspect of the economy and not be overly reliant on real estate and property, which, as I'm sure the economists over at the Beijing administration know full well, property booms and busts can be the rise and the downfall of many Western economies. So there's no reason to believe it can't happen to them as well. Once again, I kind of reiterate saying that it's more of a short-term solution rather than actually a long-term kind of fix to the Chinese economy.
A short-term solution, you say, but typically, Jose, China has not used those universal cash-in-hand measures to stimulate the economy. The US definitely does that. The Chinese, they seem to prefer to rely on their financial system to support the private sector. So they do preferential tax policies, they do fee cuts, they increase government spends and investment so that they indirectly support the real economy. Do you think that's a model that other countries facing a slowdown now would adopt going ahead?
No, Vikram, because I think that China can do that because they have high unemployment and low inflation. Other countries right now, they have high inflation and low unemployment. So So no, that formula would not work all around the world currently.
David, globally, markets have reacted rather positively, like I started off by saying, with this kind of huge Chinese stimulus package. Which are the sectors, in your opinion, that you see showing the most enthusiasm, at least in the near term, on the prospects of this huge Chinese stimulus?
Well, we've seen a major bounce back in industrial metals in the past 12 to 24 hours. This week, we saw the likes of industrial. We've seen high-grade copper fall to a 17-month low. Silver fell to its lowest level in over 2 years. So anything in the kind of mining sector has benefited greatly from this. So the timing of this was well played by Beijing, because only in the last 24 hours, 48 hours, we saw a major sell-off in those commodities, and therefore those mining companies that are kind of long connected to the growth of China are most likely to benefit from such an uplift.
Fair enough. We'll have to see whether the kind of enthusiasm that markets have shown in the last 24 odd hours, that's going to sustain or not, and whether these measures, as expansive as they may be and as unique as they may be to the Chinese economy, whether they're going to be enough to achieve that 5.5% growth target that China has set for itself. Of course, we'll get a clearer picture after the economic data shows up for the next quarters. But thanks for joining us with your perspective on this, David and Jose. We continue to watch the space that China has created. But meanwhile, we're also